Is the bond market unraveling on a global basis?
Well, the long ends, Tom, look very fragile. And there's a completely different narrative if you focus on, say, the 2 to the 5 year, because those bonds just about everywhere reflect what the policy rate is and where it's going to go. And the point is, if you take the 2 year Treasury, it's moved to price in 3 cuts now to 2 hikes or something like that. So
Hmm.
if you've got a 4 to 5 rate hike net move, that explains the yield shift. Now, in the longer end, it's very different. You've got competition from hyperscalers. You've got equities performing so well that no young person understands why you'd buy a bond. And then you've got concerns about fiscal policy, which
Right.
I suppose give you fiscal risk premium. But it would be wrong to put it all on the debt side of things. It is
How
a factor, but there's others.
how do you respond to the American debt and deficit, where the Secretary of Treasury and many others, to be fair to Mr. Besant, want to have short-term paper, lots of T-bills, lots of 1 year, lots of 2 year paper?
Yeah, so they're doing that, aren't they? And it wouldn't surprise me if they shut down the issuance of the ultra long paper. I mean, you can see it's getting a bit more fragile for the 30-year papers. I think we've got a 20-year coming up. 20 years never go well in the best of times. It's a very strange maturity. It kind of sticks out on the curve. Some people call it a dog for a good reason, but I think they keep reducing the WAM, the weighted average maturity of the debt. Now that causes other problems, doesn't it? Because it's refinancing risk. Go back to your fixed income textbooks; they've got more rollover all the time. So you can do it to a certain extent, but at some stage, there's got to be some fiscal responsibility. And one of the things I'm noticing now is that there are a few countries, Germany, Switzerland, even the UK to some extent, have some kind of fiscal plan or debt brake in place. When you've got that, it does give a lot more confidence to the bond investor. But when it seems the spending is just going up and up and up and there's no constraint, that scares people. But I'm not going to be one of those that says it's all about the debt, because it's clearly something else. It's the equity market doing well, earnings being strong, and the competition from hyperscalers.
Steve, we're going to hear from Fed Chairman Warsh and some others next week in Jackson Hole.
Yeah.
But one could argue the bond market's already speaking. The 10-year Treasury is at 470. I don't think we need to wait on the Fed. What do you expect to hear?
Yeah, so the Jackson Hole is always a great stage, and often you get set pieces released here. And in fact, I just wrote a note on it this morning, and I reminded myself there's been the Bernanke QE2. There was Powell's short speech in 2022 that told households that it's going to get tough, or things are going to get tight, whatever the exact words were. There will be some pain, I think he said. You go back over the years and it can be a big swing factor. I think the big issue today is probably the Japan-US bilateral relationship, the intervention, the potential use of the repo lines, how that's supposed to work. I think pressure from the US on Japan to lift policy rates, all these things are going to be quite interesting. Look, normally these conferences deliver some quite lengthy, meaty papers, very academic in nature. But on the sidelines, you get interesting conferences, or you get discussions, and you'll have interviews that you'll be doing yourselves. So, maybe we'll get some insight as to what Mr. Warsh is thinking. He's been very clever so far, not to let anyone know.
So, Tom and I were just mentioning this, or noting this morning earlier, the Japanese 10-year. It's at a 30-year high. What does that tell you?
Well, there's a few interesting things happening over these last few months, in that we know that the Japanese government is starting to push the GPIF and others towards buying some domestic bonds. And where the public sector goes, the private sector will follow. So that gets to the point where the yield on Japanese bonds is just too attractive for those domestic investors, and they'll have to move in. Now, what they're going to sell is what they hold overseas. So they've got a lot of equities, not just bonds. People tend to focus on the Treasury market. I don't think that's where the risk is. The risk is what the Japanese investors might sell in equities and credit to bring back home to go into those really enticing yields. But I think that to make those yields really attractive, the Bank of Japan paradoxically needs to be hiking rates. That may sound a bit odd,
Right.
but they need to get a grip on the long end, and the only way they can do that is by pushing the short yields up.
I mean, Paul, can I say that Stephen Major's moving the market? Because I'm
Absolutely.
seeing the market move here. Stephen Major, I got a creep on the 30-year U.S. from 5.25, 26, 27, and we just did essentially a jump condition to 5.28%. I mean, what is the ramification of the long end unraveling in France? The long end, I get Japan is idiosyncratic, I guess, or the shocking deflation yields that we see in China. I'm not saying it's August 98, but come on, there's a tension here.
Yeah. There are some parallels, and I think you're right to be concerned. The only point I would say is that it is August, so maybe the big movers and shakers, apart from yourselves, of course, are not at their desks. So it's that time of year. Things do tend to happen in August, though. Is the higher 30-year yield in France a trigger event? Probably not, because from the French Treasury's point of view, they've already issued their bonds. They're paying coupons at a lower rate. They too can shut down the issuance of the longer end. So I think ultimately it's an opportunity for life insurance companies, long-term investors to lock in high fixed-term yields, but they have to be brave because quite clearly the momentum's against them.